It's the start of the spring home buying season. Let's review how the 2026 housing market is positioned compared to last year at this time. Inventory is 13% more than when we started last year. Inventory is not increasing quickly right now, but there are enough homes on the market to keep prices from climbing. Home sales are happening at a pace about 1 to 2% more than last year. Some states like New York and Illinois are still supply restricted, and home sales are still at or below last year's levels. Prices are essentially unchanged for the year. Depending on how you measure prices, they're up 1% or flat or down about 1%. There's nothing in the data now that suggests big moves down or up in 2026. Flat is the new up on home prices. The big variable right now is that mortgage rates are 90 basis points lower than at the start of 2025. Your mortgage payments will be roughly 7% cheaper if you buy now than if you bought last January. Some buyers are taking advantage of that opportunity. How many is what we'll see as the spring season commences. So, the next few weeks, we'll see inventories start to rise. Prices will start their seasonal increase. Typically, in the spring, the best homes meet the greatest demand, so prices are higher, price reductions are fewer, days on market drops. In a normal seasonal pattern, new listings start ticking up immediately in this first week of January. If there are more sellers than buyers at that time, inventory will start climbing too. Most years, we see inventory climb reliably by the end of January. When the market is really hot, like it was in 2021, there are more buyers than sellers, though. So the unsold inventory on the market can keep declining much later into the spring. In 2021, even though new listings started up like normal years, demand was so strong that inventory kept falling all the way into April. So this supply-demand balance is an excellent way to get early insight into how the housing market will perform for all of 2026. So that's why we do this data every week. All right, let's start today with a look at how recently lower mortgage rates impact the monthly payments you'd make as a home buyer this January. Mortgage rates are about 6.2% for the 30-year fixed mortgage right now versus 7.1% a year ago. 90 basis points is a pretty significant improvement. So in this chart, we made some assumptions about the purchaser using current median price of the pending home sales, which is $382,000, assuming a 10% down payment. That creates a mortgage payment of just over $2,100 per month. Last year at this time, the payments would have been almost $2,300. See the left end of this chart, the blue line is where we're starting the year. Because mortgage rates are really close to their lowest level in 3 years and home prices are not climbing, your mortgage payments is around 7% cheaper than at the start of 2025. And every little bit helps affordability. We haven't yet seen this affordability improvement turn into a surge of home buyers, for example, but it is an optimistic position compared to last year at this time. So stay tuned. Now, affordability is a function of mortgage rates and also home prices, of course. By many measures, home prices across the country are starting 2026 just below January of 25 and even below 2024. For example, the median price of all the active listings now is $415,000, which is 1% lower than the first week of 2025. That's what we're showing here. At the left end of the chart, you can see the blue line for 2026 starting the year just below the last 2 years at $415,000. That's the median list price of all the homes available right now, single family. I like the list price measure because it describes the market. If you want to buy a home today, this is what's available. By this measure, homes are now 1% cheaper than last year. I've included the gray line from 2022 on the chart. In most years, home prices climb pretty quickly in the spring and each year about 5% home price appreciation, most years. But this is the fourth year in a row now where home prices are staying basically unchanged for the full year. And that's why I said early, flat for home prices is the new up. Uh, I've shown price per square foot recently too, using the square footage for homes. We get a normalized measure across property types. By the price per square foot measure, home prices are 1.4% cheaper than a year ago. If we look purely at the homes going into contract, the weekly pending sales, these are coming in at just about 1.4% above last year. So that makes a little range, down 1% to up 1%. In all, home prices are essentially flat from a year ago. And we expect this pricing behavior all year. Our forecast is to finish the year up by just 0.5%. There's nothing in the data now that says prices will start falling faster. And there's nothing in the data that suggests prices are rebounding. As mortgage rates have been improving, that probably provides a little support for prices. If we get unlucky and rates jump back to, say, 7%, that would be a catalyst for prices to leg down. But that's speculation. That is not in the data now. But there is plenty we can already see in the data. For example, we start the year, there are just over 36% of the homes on the market that have taken a price cut from the original list price. The trajectory of this data has actually been trending lower over the holidays. It's now right about the level where we started 2025. As we roll into the spring, the slope of this line is our handy measure for demand. In the spring, we get fresh inventory. Those homes obviously don't have price cuts until they're on the market for a while with no offers. When the fresh spring inventory is met with improving demand, price cuts take longer to accelerate. So in this chart, each line is a year. At the left end of the chart is the start of the year. So see how there are fewer price cuts until February and March. That's because the first spring inventory starts to age at that time. In 2023, the yellow line here, there was surprising demand in the spring, and we could see it very quickly in the downward trend of that yellow line. So that was coming off a very slow end of 22. So this data was unexpected at that time and very insightful. So what we're looking for now is how quickly and how long the blue line for 26 keeps sliding lower. If it flattens and turns up early in the season, that's our signal that demand is light and price pressures will resume. If you are a seller this spring, you want to keep your eyes on this data. When you price your home, you want to be ahead of this curve. So on to home sales. As I mentioned, the weekly pending home sales start the year just fractionally better than a year ago. So the weekly recent average is 42,000 single-family homes going into contract per week. That's 1.7% more than last year. It's not a lot of growth, but it is better than the alternative. So this includes, of course, the holiday week. So starting next week, the sales rate picks up substantially. The gray line in this chart is 2022, which started out stronger with literally 25% more sales happening than are happening now. 2022 was the tail end of the housing boom, the pandemic boom, of course. And so everyone was trying to get their deal done before mortgage rates started climbing. So we're not going to get 25% growth in home sales this year. I'm watching this data for subtle growth. Do 5% or 8% more people take advantage of improved affordability over last year? I expect some, and we will look for it in this data each week. Inventory declines over the holidays, of course. Usually by February, inventory starts rising reliably for the spring. Last year's withdrawal phenomenon, the delistings, continued in December, and as a result, there are fewer homes on the market now than we had been expecting to start the year. Last fall, we were forecasting to end 2025 with nearly 800,000 homes on the market, but there are only 720,000 single-family homes for sale at the moment. Sales are up only a little, so that shrinkage is really from delistings. And so in this chart, each line is a year. The blue dot at the end, at the left end of the chart, is where we start 2026, 720,000 single-family homes on the market. That's 13% more than last year. The blue dot is above the purple line from the start of last year. Delistings, withdrawals, are totally common over the holidays. Inventory always shrinks over the holidays, and so what we're watching for in the spring is how quickly inventory rebuilds. In years where demand picks up, inventory takes longer to build. In years where demand is weaker, inventory can start building earlier. Last year, because demand was weak, as mortgage rates were in the sevens last year, inventory started climbing between the second and third week of January, very early. So this tells us that by the end of January, there's a lot of signal about how the full year is going to go. So keep your eyes here and on the new listings rate over the next few weeks. So do last year's withdrawals come back in force? Is all that supply met with any pickup in demand due to improved affordability? Maybe those withdrawn sellers are not yet ready to try again and inventory stays lower for longer. So these are the questions we're looking for answers as the 2026 home buying and selling season gets underway. On balance, the momentum is slightly positive. Affordability is improved over last year at this time. There are more selections now for buyers. So let's see how many buyers take advantage this spring. Stay tuned.